Okay, so today we're looking at February-March 2024, question paper 12. Couple of difficult questions in this paper, but a big variance really, because some of them are very easy also. So again, we're going to start at the bottom. Okay, so what is not a likely cause of a deficit in the current account, the balance of payments? So again, we just simplify it and we say that what's a deficit? Deficit in very simple terms, excluding the other factors, is that imports will be higher, not versus, will be higher than exports. So basically we're looking for reasons why this might happen. Okay, now we do need to remember that it does consist of other balances like the primary income and the secondary income balances. So we start at the bottom. The wage costs of production are high. What's that going to do? That's going to inhibit, or it's going to reduce our ability to make goods in our own country. So it's possible that through the cost of production for the wages being higher, that the price of the product will increase and that the exports will actually be reduced. So it's possible, but it is more likely to affect our AS, right? AS going to the left, creating our cost push inflation. If the rate of the exchange rate is high, that's an appreciation. When we have an appreciation, what we know happens is that our value of imports will go up and our value of exports will go down, which will be the opposite of what we're looking for here. We're looking for a reason why imports would be higher than exports. Primary incomes in the form of investment income are low. So what's that going to do? That's going to reduce the balance on the primary income, but it may not have an effect on the deficit in the current account balance of payments. There's still other components to it. So that in itself is not going to affect imports, right? It will just affect the primary balance, but the secondary balance and the balance of trade in goods or the balance of trade in services may actually still result in us having a deficit on the current account balance of payments. So if we have consumer spending that's low, that is not going to cause, or is not a likely cause of a deficit in the current account balance of payments. So if consumer spending is low, it's not going to be the cause of a deficit. The rate of exchange rate being high can cause a deficit. The wage costs of production being high can cause a deficit, and the primary incomes being low can also cause a deficit. Sorry, I'm feeling a little bit ill today. So the diagram shows the market for both domestic and imported computers for an economy. World price is P1. Which government policy would lead to a price of P2? So they're trying to trick you out here, really, okay? An embargo on imports would place a ban on imports. So what we can see is that basically we're looking for the scenario where our supply curve is going to shift to the left. So where the price of the product is going to go up and the quantity that's traded is going to go down. Now an embargo that's placed on imports will put a ban on the imports. So it's not like it's going to shift the supply curve to the left. It will not actually allow imports to come into the country because there'll be a trade ban. An exchange rate appreciation, what's that going to do? That's not going to raise the price of the imports, which we can see has happened here, right? The price of the imports, so the price of the imports will actually go down when we have an appreciation, and the total level of imports will come up, so the quantity traded would be expected to increase as well, not to decrease like we can see from our curve. A subsidy to domestic producers, what would that do? we can see here that the domestic production has actually increased in price more than the imports, which this has to be. So we definitely haven't received a subsidy, because if we had received a subsidy for domestic producers, we would expect the domestic equilibrium price to be below where we started, because we would expect the supply curve to shift to the right, which it hasn't. So the only logical option is a tariff on imports, which makes sense because we know that a tariff on imports will shift the supply curve to the left, increasing the price of the product and decreasing the quantity that's traded. Okay, 28. Very simple. The table shows the goods balance and the services balance for a country in selected years. Between which years did the overall goods and services balance change the most? So all we have to do is calculate the change in balances, right? So for 2015, we can see that the overall balance for balance of trade in goods and services would be plus 90. It would be plus 80. In 2016, it would be plus 40. In 2017, plus 70. In 2018, and plus 90 in 2019. So once we do that, we just have to pick the 2 years that have the biggest significant change. We can see from 2015 to 2016 there was a change of 10, but there was a change of 40, which is the biggest, from 2016 to 2017. So B will be our correct answer. Okay, 27. The table shows an extract from a country's balance of payments. What is the current account balance? So again, very simply, these are our four components, 1, 2, 3, 4, on the current account balance of payments. Exports is just basically the money that we're generating, right? So it's the money that's coming in, they're recorded as credit items. The imports are recorded as debit items because they're negative, they're being taken away. So all we have to do is count the balances and then add them up together. So our balance for the trade in goods is going to be exports minus imports, which would be minus 50 billion. Balance of trade in services is going to be positive 20 billion. Positive 20 for primary income, and negative 5 for secondary income. So if we add those together, plus 40 minus 55, current account balance of payments is minus $15 billion. Okay, 26. When must the terms of trade of a country change? Okay, so this is quite simple. What's likely to happen, or with the terms of trade, all we have to know is like what the definition of it is. And the definition of it is the index of export prices divided by the index of import prices. Okay, once we know that definition, we can match the correct answer to average price of exports rises and the average price of imports falls, because it's going to be our index of export prices going up, our index of import prices going down. So we know that we're going to have a change in our terms of trade. Okay, it's nothing to do with volume, it's nothing to do with total value, and it's nothing to do with the balance of trade moving from deficit to surplus. It's just purely their average price. 25. A government decides to allow the country's currency to depreciate to remove the deficit on the current account balance of payments. What is the most likely reason why this would not work? Okay, so first of all, you need to figure out what it's going to do. So a depreciation is going to be designed to increase total exports. Okay, so the export prices will go down, total exports will go up. and it's designed to decrease the total imports. So the price of imports goes up and the total import expenditure goes down. Now, we're trying to get this to remove the deficit on the current account balance of payments. So basically what we're saying is we're trying to get this to work just like we know it should, where our imports will go down and our exports will go up. Now, if we gain a competitive advantage from depreciation, that is not a reason why it would not work. That would help it to work. Because remember that a competitive advantage means we have an advantage over other countries when we're exporting our goods and services. So that's actually going to help us remove the deficit. If we have a surplus on our capital and financial accounts, remember that the capital account and the financial account, they're other components on the balance of payments. The current account is the main one we get asked about, but the current account, the capital account, and the financial account, they all make up the balance of payments together. So they would actually not be affected, or they would not have an effect on the current account. And if the price elasticities of demand for the country's exports and imports are greater than 1, then the effect of the depreciation is going to work perfectly. Because the price of our exports go down, we would be able to increase our total export revenue, because our demand would increase by more than the change in price. And because the price of our imports would go up with a depreciation, we would be able to reduce the total import expenditure that we spend. So the logical option here is that there are high trade barriers within or with the country's main trading partners. Okay, now 24. Table indicates the factor inputs required to produce wheat and cars in country X and Y. What makes it possible for both countries to benefit from trade? Okay, so when we're talking about benefiting from trade, we know that they're talking about a comparative advantage. Okay, and we're basically saying which country has the advantage in which. So if we look at country X here, or country Y first, what we'll see is that they're taking 3 times as many units of the factor inputs to produce one car as country X is, and they're taking twice as many units of factor inputs to produce a ton of wheat as country X. So what does that tell us? That basically tells us that country Y is going to focus on wheat and country X is going to focus on cars. Okay, so Y would be focusing on wheat, X would be focusing on cars. That's where their comparative advantage is, the lower opportunity cost. Absolute advantage for A and for B, that's not going to apply to these questions because we've not been given any level of output. So remember that for absolute advantage, we need to have the level of output provided, or to be able to calculate it. We can't calculate it here, we're just seeing how much resources they need to allocate to certain goods that they want to produce. So therefore, C, Y has a comparative advantage in wheat production is correct. The opportunity cost of wheat and car production is not the same between both countries. And we can see that the opportunity cost of producing either wheat or cars will differ from the different countries because they've got different factor inputs that they need to put in. Question 23. What is considered an expansionary supply side policy? So remember that expansionary or just supply side policy is designed to move AS to the right. It's designed to increase our aggregate supply. So sales tax will not affect aggregate supply. It's a microeconomic concept. An increase in the rate of interest, what's that going to do? That is going to move AD to the left. So it's not going to affect AS. It is a contractionary monetary policy. Increase in the exchange rate, same thing. That is going to move AD to the left. An appreciation of the currency is another type of contractionary monetary policy. But if we increase government expenditure on training, we're going to make our workforce more productive over a long period of time. We may be able to increase our productive capability by moving AS to the right. Okay, diagram shows aggregate demand curves for an economy. What is most likely to have caused the shift from AD1 to AD2? Okay, there's a couple of questions like this in this paper. I don't really like the style of question, the way they ask it, to be honest, but common sense will apply a little bit. So what we've had a decrease in aggregate demand, okay? Now, what does that mean? That means that our components of AD, so C plus I plus G plus X minus M, those components have gone down, right? So, first thing, for us to have AD going to the left, when we have an income tax, we know that the income tax has to go down. Income tax has to go up, which will bring the spending down, because we'll have to use contractionary fiscal policy, right? So we can take out A and B because we know that the income tax is not going to decrease. Decreasing the income tax for these two here, that would move AD to the right. There would be expansionary fiscal policies, which is the opposite of what we have in this question. So, sales tax. Now, again, common sense applies. If we have, let's say, for example, a decrease in sales tax, what's that going to do? That's going to allow more consumer expenditure to happen, because we would have more money freed up for people to buy those goods and those services. So if we have an increase in the sales tax, it's most likely to cause AD to shift to the left, because we would have goods and services becoming more expensive. So we may have a drop off in this consumer expenditure, which, instead of correcting the shift that would happen through an increased income tax, we would move further to the left, which is what they were obviously trying to do. (21) Country has an unemployment rate of 8%, an increase of 2% from the previous year. At the same time, their current account deficit rose from 3% of GDP to 4% of GDP. So I'm not going to go through the current account deficit stuff again, because we've explained already what that is. How or what could they use to reduce both unemployment and the current account deficit? Okay, so basically what we're trying to figure out here is what is going to allow us to increase our real GDP, right? In other words, to move AD to the right, or to have increase in real GDP, because we know that real GDP is directly correlated with the level of output. Higher real GDP, generally higher output, except for certain circumstances. But for this is the way we'll think about it. And then current account deficit, we know that we need to increase our exports. Okay, so which one is going to do that? That's going to be a depreciation of the currency. A depreciation of the currency, what is it? It's an expansionary monetary policy, which is designed to do exactly what we've said over here. It's designed to move AD to the right, and it's designed to increase the total exports and decrease the total imports, which would allow us to move our real GDP, therefore creating less unemployment, and to address the current account deficit by increasing the level of exports. Decreasing government spending, what would that do? That would move AD to the left, which may actually create more unemployment and will not address the current account deficit. Increasing indirect taxation, that will put less money in people's pockets. It may, it will affect the cost of production for firms, which may actually over the long term result in more unemployment anyway, because it may make it more expensive for the firms to make the goods or services, which means that their margins will decrease. And increasing the interest rate again is designed to move AD to the left, not to the right. Okay, increasing indirect taxes will move our regular supply curve to the left. Okay, but it may have an effect in the long term on the rate of unemployment, depending on the industry that it's placed on or how many goods and services it's placed on. Okay, 20 is very simple, and so is 19 and 18. A government has a balanced budget, so their revenue is equal to their expenditure. They increase their spending by 10%. Which increase in government revenue would produce a budget surplus? So all we need to know here is, what is a budget surplus? A budget surplus is where government revenue exceeds or is bigger than government expenditure. Okay, so very simple. We just need to find a number that's bigger than plus 10 plus 20. 20% increase in government revenue compared to a 10% increase in government spending would result in us moving from a balanced budget to having a surplus. 19. Aggregate demand in an economy may decrease as a result of an increase in. Okay, so again, we're going to be looking at our components of AD, right? So what's our components of AD made up of? C plus I plus G plus X minus M. Consumer expenditure, investment, government spending, exports and imports. So if we have an increase in import expenditure, what's that going to do? That's going to increase M, which is going to make our net exports fall, assuming that exports stay the same, which means that AD will go to the left. Okay, which is why it's our correct answer. If we increase any of the others here, they will all result in AD moving to the right. Investment expenditure will affect investment, which will move AD to the right, because we said that we're increasing investment expenditure. We're increasing government expenditure, which again is another component of AD, and we're increasing consumer expenditure, which is another component of AD. They will all move AD to the right. Okay, 18. To calculate the unemployment rate, the number unemployed is related to. That is the total population in the labour force. So remember that to calculate the unemployment rate, it's very simple. We just have the formula. And the formula is the number of people unemployed divided by the total population in the labour force. It's not the total adult population, because some of them are not in the labour force, so they're not counted as being unemployed. It is not the number of unemployment people is related to the number of unemployment or unemployed who are seeking work, because we need to divide it by the number of people we have that is possible to work. And the same with the number in full-time employment. That's not going to give us an accurate calculation if we divide the number of employed divided by the number of unemployed. We need to divide it by the number of people that it's possible who can work in the economy. Okay, formula is available for that. Again, it's just like a definition question really. It's something that you just have to learn, and it's available on the slides and the revision notes. Okay, 17. According to the circular flow of income, what would be the immediate result of an increase in the value of a country's exports? Okay, again, another very simple question really. That would be national income. Okay, if you think about it this way, if we have an increase in exports, that may not necessarily have an increase in the level of imports. Okay, just because we're exporting more doesn't mean that we're importing more too. Just because we're exporting more doesn't mean that we're saving more. Something like the rate of interest would have an effect on the level of savings. So we may be able to export more, but our rate of interest may be very high or maybe very low, so people are not going to put their savings into the bank account. And taxes would increase. The level of exports does not affect the taxes that we have too. What it would affect is the national income. So because it's export revenue, what we're doing is we're basically generating more money coming into our country, right? Which means that on average, the income levels that we have in the country will increase. (16) What is least likely to cause a simultaneous increase in demand pull and cost push inflation? Okay, remember what happens with these. Cost push is AS to the left. Demand pull is AD to the right. Okay, so if we go through these, a depreciation of the currency, what's that likely to do? That could cause AD to go to the right. Okay, so it could cause demand pull inflation, but it may also possibly cause cost push inflation. Okay, why? Because the price of our imports have gone up when we depreciate our currency. So if we don't have the availability of buying from domestic producers, for example, we may still have to import the goods at higher prices from other countries, and that would increase our cost of production, which would mean that we may generate some cost push inflation. AS moving left. Increased import tariffs. So again, that may cause both types of inflation. The increase in the tariffs, just like I said previously with the last question really, that may actually result in costs going up in industries, for example, where we can't make domestically the raw materials that we need to import, so they have to continue to pay the higher prices on the imports, and it may result in demand pull inflation at the same time. So if those firms get the goods that are coming into the country at higher raw material prices, what it may do is it may then increase the domestic price level for those goods and services that are being sold on the domestic market, which may actually cause demand pull inflation as well. Correct answer is C, because if we decrease spending on infrastructure, what's going to happen? We're going to have a movement. That could be spending or AD related in AD and AS, but it's not going to increase our cost of production, and it's not going to result in more spending in the economy. So remember, cost of production is relating to cost push. Basically, spending in the economy is relating to demand pull. Whereas if we have increased wages, that may result in people having more money to spend, so it may result in AD moving to the right, and it may also result in cost push inflation because it increases the cost of production for firms. Also, just in case I didn't explain it, the increased import tariffs, they may actually also cause demand pull inflation, because we may actually be spending more on our total level of imports, especially if the elasticity of the imports is inelastic. The increase in the price is unlikely to change the demand, so we may actually have more imports that are being brought in, or simultaneously, if it's elastic, we may have less imports being brought in, but the domestic industry, like I said, is more likely to have increases in their own costs, which may mean that domestically consumers are paying more. Okay, and they may not have the choice of importing from other countries then. Okay, 15, simple. So correct answer is C. Very simple. Just read through these. This is wrong. Inflation reduced the real value of GDP for 6 months of 2021. Wasn't inflation, it was deflation. Real GDP was lower at the end of 21 than 2020. Not true. Real GDP was higher. Standard of living was higher. Can't conclude that from a table. Economy was in recession. We can't conclude. Start at 100. We have 3 months of real GDP falling. We then have 6 months of real GDP falling here. What's the definition of a recession? It's a consecutive fall of 6 months or more in real GDP. Okay, 14. A country uses an income tax under which the first $10,000 of income is tax-free. The next 20k is taxed at 20%, and any income over 30,000 is taxed at a top rate of 40%. It also levies a sales tax on most products. Which combination of tax changes is most likely to create a more equal distribution of income in the country? Okay, so the first thing we're going to do is we're going to take away the income tax ones that definitely won't result in a more equal distribution of income. And that would be a lower tax-free allowance, because it's taking money out of poor people's pockets, and it would be a lower top rate of tax, because then it would become less progressive. We would have people who are earning higher incomes paying less. So a higher tax-free allowance may allow us to have a more equal distribution of income, because it will allow, or it will make it even more progressive, the lower earners to basically be able to earn more without paying any tax. Same thing with a higher top rate of tax. That's going to make the tax more progressive. Higher earners are going to pay a higher percentage, which means that it allows the government then to redistribute more income through transfer payments. So when it comes to the sales tax, the one that's most likely is going to be the one that results in the lower sales tax, right? Now, why is that? That's because that's going to allow people to buy goods and services at a cheaper price, right? Now, if we can buy goods and services at a cheaper price, that's going to allow the low-income earners who are now receiving the transfer payments from the government through the additional tax revenue they've made from increasing the top rate of tax, to have more money available to spend, and to be able to spend it on more goods and services due to the fact that the sales tax has been reduced. So those two would be the most likely combination. What explains the underconsumption of merit goods? Simple, it's information failure, which is that their value is not fully understood by consumers. Okay, it's one of the first things that we go through in Unit 2. It's not because they're unproductive, they have benefits for society. They can't, or they're not only provided by the government, they're provided by private firms too. And they're not only provided by private sector businesses, they may also be provided by the government. So they can be, there can be the mixed provision of merit goods. 12. A policy that aims to reduce the degree of inequality of income will also reduce the level of employment in a country. What is most likely to be such a policy? Okay, so if we start at the bottom here, the government provides more goods that are regarded as essential. Okay, that's great, but that doesn't address the inequality of income, right? Because it's nothing to do with how much they're earning. If the government increases the level of subsidies given to producers of some merit goods, again, that doesn't reduce the inequality of income for society, and also will also reduce the level of employment, so create unemployment. I nearly missed that part there. So again, giving the subsidy, that's not going to result in any form of unemployment, is it? Subsidy is something that actually helps us when it comes to employment. And the rate of income tax by the lowest band of earners is reduced. Okay, what that may do is that will result in a degree of, or reduce the degree of income inequality for sure, yeah. but it is not going to result in more unemployment. It's going to actually possibly increase the level of employment, as more people are incentivized to go to work due to the higher net income that they're going to receive. So correct answer here is A. If we increase the effective minimum wage by 25%, what's that going to do? It's going to make it reduce the income inequality, because somebody who was earning below that rate before or on the minimum wage will now have a 25% increase in income. And at the same time, it's going to make it more expensive for employers to hire labour, which will reduce the amount of labour that they will need to demand, or that they can afford to take on for their business. Okay, very straightforward question. Again, what area represents producer surplus? So remember, if I can just show you here, PVW, the area above the price to the top of the demand curve, is what we call the consumer surplus. Okay, and that's how we remember it. Above the price level to the top of the demand curve. Producer surplus is below the price level. So basically like the minimum price that the producers would be willing to sell the product for in the market, down to the bottom of the supply curve. So that would be PUW or PWU. Okay, same thing. So producer surplus and consumer surplus, never going to start from the origin point here, so anything with the O is incorrect, unless our demand and our supply curves originate from the origin, but that's highly unlikely. Okay, so the easy way to remember it: producer surplus, below price level, bottom of supply curve. Consumer surplus, above the price level, top of the demand curve. Okay, 10. Butter is a normal good. It is in joint demand with bread and in joint supply with buttermilk. The demand for butter increases because of a rise in consumer incomes. Okay, so it's in joint demand with bread, which basically means that it's a complement, right? Therefore, if the demand for butter increases, the demand for bread is obviously going to increase also. Now, what's going to happen with the buttermilk is the opposite scenario. So because they're in joint supply, what's going to happen when we have an increase in the demand for butter and an increase in the price of bread is we'll actually have a decrease in the price of buttermilk. Because they are like the second or the alternative use of that good, what's going to happen is that it will decrease when we have butter increasing in demand and our complement of butter, bread, increasing in demand. Now, if you want to recap on them, you just go to your interaction of demand and supply slides / unit 2 notes, and joint demand, alternative demand, derived demand, joint supply. We've got diagrams which are given for all of them. Okay, so just go to that section if you need a further explanation. You can check them out on the slides. PES of yogurt is estimated to be 1.5. If the demand for yogurt rises and price rises by 20%, how much more will the supply be to the market? Okay, very simple to calculate. So basically, we're looking for X, aren't we? X is our quantity supplied. Price goes up by 20%, and we know that our PES is 1.5. How are we going to get to 1.5 here? We must have had a 30% increase in quantity supplied. Okay, very difficult question, this one, right? So, first thing that we need to identify from it is that we've got a linear demand curve here, right? Now, if you remember from your slides, we drew a linear demand curve, and we said that basically what happens is that when we have the linear demand, the elasticity is going to change at different points, right? I'll just put it as demand, okay? Here, somewhere at the top, our elasticity is going to be higher, right? So up here we're going to be elastic or highly elastic. Now, why is that? That's because we're dealing with, if I can just bring this down, we're dealing with a smaller total amount of the quantity, which means that any change in this quantity is likely to be a larger percentage change. The further along the linear demand curve that you go, the more the elasticity becomes inelastic, right? I like to think of it very simple way. The further left you go, the more elastic you are. The further to the right you go, the more inelastic that you are. Okay, so in this example here, this is what we know is happening with X and Y, right? So Y is going to be elastic here, unitary here, and inelastic here. X is going to be elastic here, unitary here, and inelastic here. Okay, so both X and Y are unit price elastic over their whole length. We've just shown that that's not true because a linear demand curve will change. They have the same elasticity at every price. That's not true, again, because we've just shown that it doesn't change. Y is more likely to have substitutes than X. Not true. PED doesn't show us the availability of substitutes. It's a factor that will affect it, but it is not something that is shown through a straight line demand curve. Okay, it's one of our criticisms of PED, basically. So C is the correct answer, and now let's show you why. If we pick a point here at a price level, okay, let's say it's here. What we're going to see is that when we go to our quantity, right, our quantity in X is going to be much less as a total amount than our quantity in Y, right? So what does that mean? That means that any change in X, if we move our price up to here, for example, because the total amount will be smaller, it will be a larger percentage change in X than it will in Y, where the total amount will be a larger figure. So it's going to make X more elastic than Y. Okay, 7. PED for a good is minus 2.4. Income elasticity is minus 0.4. Cross elasticity, good X, good Y is plus 0.8. Okay. Easy question if we've learned off our different things. So what does that make it? First of all, income elasticity demand is minus 0.4. That makes it an inferior good. With good to respect to good Y plus means that it's a substitute, but it's not a very close substitute. And income or PED is minus 2.4. That makes it PED elastic. Okay, so all we need to do then is match it up to what we find. We know it's an inferior good, it's not a normal good. If it was a normal good, remember that the income elasticity of demand would be a plus figure, not a minus. So it's price elastic demand, not inelastic demand. And we just shown that it's a substitute because it's a plus. Remember that a minus for XED would make it a complement. Okay, another one that's very simple. We talked about this in class, the difference between notional and effective demand. We said notional demand is the one that's speculative. It's like the idea that we want to buy something. I would love to buy a house, but I just don't have the money. It becomes effective demand for me to buy the house when I'm supported by my ability to actually purchase it. Okay, so effective and notional demand are nothing to do with the relationship between price and quantity demanded. It has nothing to do with the total amount that's demanded either. It's basically notional demand is the idea, effective demand is the ability to be able to follow through on the idea or to actually pay for it. Question 5. What is the opportunity cost to a person of spending $20 on a new pair of sports shoes? Okay, simple. What is the definition of opportunity cost? It's the next best alternative that we've given up. Therefore, the correct answer will be D, the next best thing that could have been bought with the $20. So we've given up the $20. Our opportunity cost is what we could have bought with that. And we've got our next best thing or the next best alternative, which is our definition of the opportunity cost. Okay, so we know the definition, we automatically know that the other three are wrong. Question 4. What is the main reason an economy is unlikely to rely on market forces to allocate resources? Okay, so we're basically talking about what's the problems with the market economy here. Demerit goods will be oversupplied. True, but that's not the main reason. Merit goods will be undersupplied. True, but that's not the main reason. Private goods will not be supplied. Completely false. They will be supplied. The main reason is because public goods will not be supplied. Okay? Because they're non-excludable and non-rivalrous, private firms will not be able to receive a price for them, which means that governments would have to step in mixed economy, for example, and provide those types of goods. Okay, which combination best describes basic economic problem? If you looked at my question paper 13 video, May, June 2024, I said limited resources, unlimited wants. Okay, absolutely straightforward question. Nobody should be getting that question wrong. You're getting this question wrong, we're in big trouble. Okay, a normative statement. So before even looking at the statements, what are we looking for? We're looking for an opinion-based statement. Okay, something that is subjective and cannot or is hard to test. So cannot be tested. Okay, aggregate demand will increase following a decrease in interest rates. That is a positive statement. It's factual and can be tested. A rise in unemployment will decrease inflationary pressures. Again, positive statement, factual, can be tested. Incentive to work will rise if benefit payments are reduced. Again, positive statement because it can be tested. Unsustainable economic growth is more harmful to the economy than hyperinflation. Normative statement because they're putting forward an opinion. Okay? And they're not saying that this will happen if we do this, which is something that we can test. They're putting forward an opinion that this is worse than something else, which doesn't give us any basis to actually test the statement. And finally, question 1. Why does a production possibility curve exist for every economy? It exists because resources have alternative uses. Okay, PPC, if you remember, we only put two goods on it. We put good A and good B. And the reason we have a PPC is that we can see what's our opportunity cost going to be as we switch the production from one good to the other good. Okay, nothing to do with the import of goods. It can show us if resources are unemployed or if they're being employed efficiently, but that's not the reason that it exists. It exists to show us how a reallocation of resources would be affected between the two types of goods that we're looking at. And resources are unlimited. We know that that's incorrect. Resources are limited. Okay, thanks for listening.